When you strip away everything, every self-help framework, every finance book, every piece of advice you have ever received about money, there are only 3 ways to build genuine wealth. They're all relatively simple to understand. It is the execution that makes them difficult, and most people never fully execute any of them. Not because they lack intelligence or effort, but because they never clearly understood which path they were on, or what the structural logic of that path actually requires. This video covers all 3, how each one works mechanically, what makes each genuinely hard, where most people fail, and how they translate into the reality of building wealth in Britain specifically, not Silicon Valley, not Wall Street, but here. Path 1, build it. The first path is the one that produces the most visible, dramatic outcomes. You build something, you create a value-producing machine, you retain ownership of it. And if it scales, the equity does something that income never can. The majority of self-made billionaires globally are founders. Not inheritors, not investors who got lucky. Founders who built something, owned most of it, and grew it. Technology, manufacturing, logistics, retail, energy, different sectors, the same mechanism. To understand why, you need to understand the difference between income and equity. If you earn £150,000 a year, that income grows linearly. You might double it over a decade if you're exceptional at what you do, but your output is still tied to hours worked, leverage within an organisation, or a negotiated salary cap. There is a ceiling. If you own 60% of a business that grows from £500,000 in annual revenue to £10 million, your equity does not grow linearly. Valuations are not based on your effort. They are based on revenue growth, profit margin, market position, and future expectations of cash flow. The repricing is often non-linear. That is the moment wealth appears. A SaaS company growing from £1 million to £10 million in annual recurring revenue might see its valuation multiple expand from 4 times revenue to 8 times revenue. That is not a 10 times gain. That is a 20 times repricing of the equity. Founders who retain meaningful ownership during that growth do not just earn more, they experience a categorically different financial outcome than any salary could produce. Here's how the build path actually works in structural terms. First, identify genuine inefficiency or unmet demand, not a product you find interesting. A problem that enough people have and are not having solved adequately. Second, create a repeatable solution. Third, standardize delivery so it does not depend on your personal involvement in every transaction. Fourth, scale distribution. Fifth, and this is where most people fail, retain ownership during that scaling. Most founders fail at step 5. They give away too much equity too early, often in exchange for validation or early capital. They build a job rather than a company, a business that stops functioning the moment they stop working. They never reach distribution scale. They confuse being busy with building leverage. A business becomes a wealth engine only when it detaches from the founder's personal labour. And the real leverage in building is not the product, it is distribution and margin control. A mediocre product with superior distribution can dominate a market. A superior product with no route to customers dies. High gross margins allow reinvestment. Reinvestment fuels growth. Growth increases valuation multiples. Multiples create equity wealth. That loop, build, sell, reinvest, scale, reprice, repeat, is the mechanism behind most entrepreneurial wealth. Most new businesses in Britain do not survive beyond 5 years. This is not pessimism, it is the base rate, and anyone seriously considering this path should look at it clearly. The failure rate is real, but the upside is asymmetric. You can lose your time and some capital. You can gain something that no employment income ever will. The payoff distribution is not normal. It follows a power law. A small number of outcomes account for most of the returns. This is why the path attracts people with high risk tolerance, but what many of them misunderstand is that building is not about passion. It is about structural leverage. You are not opening a restaurant because you love food. You are building a repeatable system that produces predictable cash flow at scale. If it cannot scale, it will not make you wealthy. If it cannot detach from you personally, it will not make you wealthy. If you do not retain meaningful equity, it will not make you wealthy. Owning 2% of something growing modestly rarely produces transformative outcomes. Owning 60% of something growing aggressively usually does. One more variable worth naming: market timing. Building in a contracting market is always uphill. Building in an expanding market compounds your effort in ways that can mask strategic mediocrity. Many British technology founders who did well in the 2010s were not geniuses. They entered expanding systems at the right moment. Timing does not replace quality, but it matters more than most founders are willing to admit. And there is a psychological cost to this path that's worth naming honestly. Income is unstable, identity is unstable, feedback is often brutal. There is no salary cushion unless you create one yourself. This is why most people, including many capable, entrepreneurially minded people, ultimately prefer employment. The emotional volatility is simply lower, but volatility is the price of equity. You do not get ownership upside without enduring the uncertainty that comes with it. Path 2, buy it. Not everyone builds the factory, some people buy the factory. The second path to wealth is not about creation, it is about acquisition. You allocate capital into productive assets that already work, and you allow time, cash flow and compounding to do the scaling for you. This is the path that most financially literate people in Britain are on, or at least the version of it that sits closest to their current behaviour. ISAs, workplace pensions, index funds, property. The structure is correct, but the depth of understanding behind it is often shallow, and shallow understanding produces shallow commitment, which is exactly the behaviour pattern that interrupts compounding at the worst possible moment. Here's the structural logic. If you own shares in a profitable company, that company operates regardless of whether you show up. If you own rental property, tenants pay regardless of whether you personally manage the maintenance. Ownership decouples wealth from effort. That is the shift. Productive assets compound. Compounding means returns generate additional returns on a growing base. Invest £50,000 at an 8% average annual return. In year 1, you earn £4,000. In year 2, you earn 8% not on £50,000 but on £54,000. The absolute gain is slightly larger. In year 3, slightly larger again. In the early years, this feels negligible. By year 20, the base has grown to a point where a single year's return exceeds what many people earn in salary. The curve bends, but it only bends if you leave it alone long enough. What counts as a productive asset? Public equities, ownership in companies that generate profits, commercial and residential property, rental yield plus capital appreciation, private businesses, direct stakes in operating companies, index funds, a slice of aggregate corporate earnings across an economy. These are assets that generate either cash flow, appreciating value grounded in underlying earnings, or both. What does not qualify? Consumption assets, pure speculation without cash flow, anything that relies entirely on a greater fool, the hope that someone will pay you more for something that produces nothing. In Britain, this includes certain corners of the property market where yield has become negligible and the entire thesis rests on perpetual price appreciation. It also includes any speculative position you cannot clearly explain in terms of underlying value production. Here's the discipline structure for the investor path. Step 1. Accumulate surplus capital, which means spending less than you earn consistently over time. Step 2. Allocate into productive assets. Step 3. Reinvest cash flow rather than consuming it. Step 4. Repeat without interruption. Step 5. Avoid catastrophic loss, which means staying diversified, avoiding leverage you cannot service, and not concentrating in single positions. The step most people fail is step 4. They interrupt the process. They buy enthusiastically during periods of market optimism, sell during downturns when the portfolio has dropped 20 or 30%, and then buy again when confidence returns, having crystallized the loss and missed the recovery. Emotion is the enemy of compounding. Systems beat emotion. The honest truth about the investor path is that it does not reward brilliance. It rewards durability. The majority of long-term wealth built through this route has come from broad exposure to growing economic systems held consistently over time, not from identifying the next exceptional company before anyone else did. You do not need to invent anything. You do not need to predict market movements. You need to own pieces of productive systems and allow compounding to operate uninterrupted for long enough. 5 years is a short time horizon. 10 years is medium. 20 to 30 years is where the mathematics become genuinely powerful, and this path has a particular relevance in Britain right now. The Stocks and Shares ISA allows up to £20,000 per year to be invested and grown entirely free of capital gains tax and income tax. The workplace pension receives tax relief on contributions. A basic rate taxpayer investing £100 into their pension pays £80 of their own money, with the government adding £20. These are structural advantages built into the British system that most people are not using anywhere near their full capacity. If you do not own productive assets, your effort enriches someone else who does. That is not a slogan. It is the arithmetic of how capital works. Path of 3. Join it. Not everyone starts with capital. Not everyone has a business idea they are willing to stake years of their life on. The third path exists for those people, and it is, for many British professionals, the most immediately accessible route. You enter an existing high-value system. You position yourself where leverage concentrates. You extract an income that is meaningfully above average. And then, this is the critical step that most people miss, you convert that income into ownership before lifestyle inflation consumes it. High earners cluster disproportionately in leverage-heavy industries. In Britain, financial services, technology, law, management consulting, enterprise sales, senior corporate leadership, and increasingly specialist roles in energy and infrastructure. These are industries where individual contribution scales, where one person's work touches millions of pounds of value rather than hundreds. Labour by itself does not scale. We have already established that. But labour embedded inside high leverage systems does. A software engineer building tools used by 10 million users creates more economic value than one writing internal scripts for a small local firm. A lawyer structuring a £500 million acquisition earns more than one handling residential conveyancing. Compensation follows the scale of impact. Here is how this path works in 5 phases. Phase 1 is skill acquisition. You develop a scarce, economically valuable capability. Not a skill you enjoy necessarily, a skill that drives revenue, reduces significant cost, allocates capital, or manages risk at scale. Scarcity creates pricing power. Generic skills in abundant supply have no pricing power regardless of quality. Phase 2 is system selection. You choose an industry where value multiplies rather than caps. A strong skill in a weak system caps income permanently. The same skill in a scaling system expands income continuously. This choice, which sector, which type of firm, which geographic market, matters more than most people acknowledge when they're early in their career and focus primarily on getting any decent job. Phase 3 is proximity to capital. You move closer to decision making, closer to deals, closer to equity grants and profit pools. This is where many British professionals stall. They become excellent operators in large organisations, valued, well compensated by normal standards, and entirely without ownership upside. The transition from operator to owner does not happen automatically. It requires negotiation, positioning, and often a deliberate move toward roles that offer stock compensation, profit share, carried interest, or equity stakes in growing businesses. In Britain, this is less culturally embedded than in the United States, where equity compensation is more normalised across industries, but it is increasingly available, particularly in private equity-backed businesses, growth stage technology companies, and partnership structures in professional services. The question is whether you are actively seeking it or passively accepting cash-only compensation. Phase 4 is aggressive conversion. Every bonus goes into productive assets. Every salary increase above inflation goes into productive assets. Lifestyle does not expand proportionally with income. It expands modestly and the surplus is deployed. This is the behavioural discipline that separates high earners who end up wealthy from high earners who simply lived expensively. Someone earning £200,000 a year and living on £70,000 can deploy £130,000 annually into productive assets. Compounding on that scale behaves very differently from compounding on the £300 monthly contribution of someone early in their career. The slope steepens dramatically. The earlier this conversion begins, the more time the compounding has to operate. Phase 5 is detachment. Eventually, the asset base generates enough return that employment income becomes optional. This is the exit from the labour path into the ownership path. The point at which you have effectively used the third route to arrive at the second. Many of Britain's genuinely wealthy individuals began as specialists. Accountants who built practices, lawyers who made partner and invested the proceeds, consultants who took equity in the clients they advised, technologists who joined early-stage companies and held the stock through growth. The pattern is consistent. Enter a high-leverage system, extract outsized income, convert relentlessly, accumulate until the assets take over. The honest difficulty of each path. Building something is probably the hardest thing on this list. The failure rate is real. The psychological cost is real. The years of unstable income and uncertain outcomes are real, but the upside is asymmetric and available in a way that no other path can replicate. Buying productive assets requires something that most people convert into consumption before they convert it into capital. It is slower and less dramatic than the other paths, but it is the most structurally reliable route to wealth over long time periods, and it is available to almost anyone who earns a reasonable income and spends below it consistently. Joining a high leverage system and converting aggressively requires you to be genuinely excellent at something economically valuable, to position yourself well, and to have the discipline to keep your lifestyle from expanding to meet your income every time it rises. None of these paths are easy. If they were, they would not be rare, but they are also not mysterious. The mechanism of each one is understandable. The structural logic of why ownership compounds and labour does not is not complicated once you have seen it clearly. The question is not which path produces wealth. All three do, reliably, for the people who execute them. The question is which path you are currently on, and whether you are actually executing it.